We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
All right, welcome back everyone to Capital Mindset live stream. It's been a while since we've done one of these. Things get busy, you know, life happens, and then when we have time, we try to get these out here. So we have some interesting topics. The first one's going to be a bit more on the academic side that I found quite interesting to kind of have a conversation about, and then we'll talk a little bit about the nuances, some issues with the study. But the study is titled somewhat like, do stocks outperform treasuries? And the study in question is by Hendrik Bessembinder. So I'm sorry if I butchered the name, but the title, if you listen to him speak, you know, he obviously titles the study to kind of get people's attention, to entice you to read it, because it is quite interesting, the findings. And some of it you might already know intuitively. You've been investing for a moment, and again, you might think, these things are obvious. I already know them. But some things kind of, when you say it out loud, it puts things into perspective. And I do think that there were some interesting concepts that I would like to highlight for you guys here, just to, again, put things into perspective. And it may or may not, you find it useful, or, again, you might say, I already knew all that. So the study was looking at the returns over all publicly traded stocks that they had access to as far as the data goes, and seeing how they performed or stacked up to treasuries. And I think the findings were quite interesting. So if you see my eyes darting, is because I took quite a bit of notes so I could go through each point line by line. But one of the key points that I found interesting, so let's start with the quantity of stocks that actually did fairly well. So the 25,000 stocks that were measured, 11,000 had outperformed treasuries. So from the 25,000, 11,000 had outperformed treasuries. And then of that 11,000, when we talk about the massive draw of wealth generation over, the given time period, we have pretty much around 4% of that quantity accounted for the vast majority of the wealth creation. So if you guys know, there's like a concept called the Pareto's distribution, which, kind of also applies here, but it basically says a square root number of any unit of measure accounts for 50% or more of the observation goal. So, an example, the square root number of forests have 50% or more of the biomass as an example. And then this kind of applies to galaxies and stars, etc. So it's something that's like a phenomena that we observe. It's actually almost no different that we see in the performance of stocks. You can take it even for employee populations. You take the square root number of employees. The square root number is responsible for 50% or more of the value in whatever thing that you're trying to measure. So it's something that you kind of see. Then some of the other points that I think are important to talk about is the conclusions of the study. So the conclusions of the study actually shown that skewness is the main observation. What does skewness mean? Well, what we just described, 4% of the stocks were responsible for the vast majority of the wealth that was generated. And by the way, so in quantity, that comes out to roughly just over 1,000 stocks, 1,100, give or take, rounding, just to keep it a nice round number, but 1,100 stocks were responsible for the vast majority of wealth. And so this concept of skewness comes out a lot, right? Where, well, what does that mean? Well, it actually strengthens the argument on kind of both sides. So I'm going to take like a neutral approach here. But for example, the index fund investors will say, hey, or the proponents of passive investing will say, the skewness has gotten even worse. And if you want to know how much worse has it gotten, so for example, in 2019, which is when he cited as one of the observations, it got a bit worse. And we'll talk a little bit about why that is, because I think there's a little bit of nuance that is lacking there. But it is still true. Roughly 5 companies accounted for 22% of the wealth generated. So recall 4% over the long period of time that was measured. And then in 2019 alone, it was about 5 companies that accounted for 22%. So he is noticing that the skewness is happening a lot more, or it's concentrating even more. And so the passive investing proponent would say, hey, well, that means that it's even harder than before. And then the other point that he kind of talks about too, and by the way, for full context, he himself is a proponent of at least his own money, putting it in a passive investing approach. Although he does also argue that in order for markets to be efficient, you do need market participants to actually go out and try to price discover, so to speak. The other part, that, you know, the other side of the coin is that when you are able to find the opportunities and take advantage of the skews, you're going to be even more rewarded than before. And that kind of points to the increase of the skew. It leads to potentially more rewarding outcomes for someone who is able to select securities. And then it also makes it maybe more difficult for someone who is not going to be participating in that skew. So you're more than likely than not to underperform the overall index or the market, or meet your investment goals. So that's something to consider. Thoughts on gold outperforming the S&P 500 year to date since 2022? We can talk about that. I'm going to start some of these comments or questions. I see a question or comment about Ingalls. We'll talk about that. TLN. We can talk about TLN. All right. So if you have questions or comments, I start them, and we're going to talk about them at the end, or at least maybe in between topics. So if you guys are liking this so far, please feel free to leave a like. This is, I'm going to try to do a podcast episode just on this. And so you won't see me, my face or anything. It'll just be like, you know, the quiet piano music. And I'll be talking a little bit more in depth about this topic. But if you guys are enjoying this more academic side, you know, feel free to let me know. And then I can try to think about reviewing other ones in the future, and we can have, you know, discussions about that. So let me go to my notes here, because there's some other bullet points I do want to cover and make sure I don't repeat myself. So one of the things that's also kind of important to note is that as you go across time, the skewness or the performance differential actually widens. And so this is kind of the discussion on compounding returns or compounding interest, which I guess is intuitive for the vast majority of you, is that as you go across the x-axis across time, the difference in performance between the top performers and the poor performers starts to get worse and worse and worse. And the top performers over short spurts tended to be, and this kind of also messed with the data, were healthcare companies, so biotech firms, and energy companies. And so that kind of makes sense. You can kind of think of the adage like, oh, you know, biotech investing is kind of like gambling. You know, you have a one drug trial, and you know, it gets rejected or it gets approved, and you can have massive returns, or you can crash and burn. So that also makes sense. But then looking at some of the companies that have, if you account for time, and so the spread out of that compounding across time, the best performers actually ended up being very boring companies. One of them is pretty famous. It's cited a lot as being one of the top performers of all time, Altria Group, the cigarette company. And then the other one being, what's the name of that company? They make the asphalt. It's an asphalt business. VCM, I think, is the ticker. We'll pull it up. I don't know why the name escaped me. No, not VCM. VMC, I think it is. VMC, yeah, Vulcan. Here we go, Vulcan. So this one also was one of the top performers since the beginning of the study. And also what it showed, they also had a low level of volatility. So the performance over time was actually just steady and consistent performance, just kept compounding over the years. And so, you know, you had done extraordinarily well. I think you're in the millions of percentage if you invest in Vulcan way back in the day. So that level of skewness does also indicate that if you have some sort of edge in any particular business or industry, or you understand a little bit more than the average Joe or the average market participant, you do now have potentially, according to what the findings say, a greater potential for returns, not less than before. And this is where I'll get into some of like the nuances of the skewness, because there are some discussions to be had about that. And I've talked about this in the past, about the constituency of the index being different today than it was back in the day. And the scalability of the largest businesses are very different from where they were before. So if you go to other countries, their indexes have a different makeup than the United States. United States has the vast majority of its largest companies are now large cap technology firms. You have energy companies that are out there, you know, like ExxonMobil, Chevron, et cetera. And you have banks that are, which we'll be talking about their earnings reports in a second. Banks like JP Morgan Chase, that's at $600 billion or so. But a lot of them are, you know, like Visa. By the way, Visa, people think it's a finance company. It's not a finance company. You can search that, but I think it's classified as information technology. in terms of what sector it's part of, and it is a tech company. It's not a finance company. They don't take any financial risk, etc. They are just the the rails by which the money transfers. So, let's take Visa for example. That's a company that scales basically infinitely, as many people as they want to use the network. And something like Google, same thing. So the scale is completely different than it was in the past. And so we just lack the imagination sometimes to understand the importance of scale and how quickly a company can scale up. And older businesses, let's call old world companies, they have a bit of a there's a little bit more involvement in how they can expand than simply just like opening up shop or allowing new people or users to sign on. So it adds, I think, a level of nuance that's missing. And when we look at some of the discussions about, okay, well, now the S&P 500 is too concentrated. I don't like those arguments because oftentimes it does also lack that level of nuance, and it can discourage someone from pursuing a index-based approach, because then they're going to start to try to time the market and not just dollar cost average into the index. Because if you add that bit of context and you understand that the constituency is different than it was back in the day, there are reasons for why it's more concentrated than before. It's just an oil company like Exxon cannot get to that size. It's not possible. They don't have that scale advantage unless you allow them to suddenly just merge and acquire all the other ones. But if you're looking at it from a comparison to Google, of course Exxon cannot scale to the same level as Google. It's not possible. So that's a little bit of the nuance. And so I think, of course, the skewness is increasing. That doesn't mean that you're not having participation. This is the other point that isn't really talked about too much in the various interviews I saw with this professor. It's that it's not, he does not negate this fact, right? So it's not like he's going to negate this. If I had him right in front of me, he probably would not negate this at all. It just wasn't talked about as much. So I'm not saying that he doesn't think this. So I just want to add that level of conversation. And it's more so to do with, it's not that there's a lack of participation, but the skewness when you have these really large companies and the $2 trillion company goes up 20%, of course it's going to overshadow the smaller company that went up 100%. And so that level of wealth that was created that you're measuring, of course, you're going to get in your measure or your reading that the company that's at $2 trillion going up 20% is creating more of the wealth. Right. But that doesn't necessarily mean, and again, he's not saying this, doesn't necessarily mean that there isn't other participation happening in the market. Far from it. And I think that's what some people took out of this, which I think is the wrong conclusion to take. Right. There is broader participation. And one thing I have been kind of fighting with people all across the internet, not fighting, but like, kind of discussing, is I don't think that this conclusion that, oh yeah, the market's really funky right now because all the participation, all the returns are happening in the top ones, because they're usually citing stuff like this. I think that's misleading, because I think that if your stocks are down, and we've had live streams about this topic, if your stocks are down and they're on the smaller side, it's probably because you bought a shitco, or you bought a company that is troubled, or you overpaid for it. If you really look at the participation in the market, I think the market's being quite rational. The shitcos are dying, right? Pardon my French. And the companies that are growing earnings at a steady or rapid pace, they're getting rewarded for it. You might find the exception. You might find that one exception. But if we get down into the conversation, I guarantee you, when you look at the valuation, there's a definite reason for why it's underperforming. So it's not like because you're the genius and then everyone else is stupid. There can be moments, a period of time where there's overlooking. But if you're if their stock's down for, I don't know, 2 or 3 years, and you're sitting there going like, eventually I will be right. I found the gem, etc. And it's not happening. Maybe there's something wrong with the thesis. And if let's say we're assuming earnings are growing, because a lot of these companies, you'll see their earnings aren't growing and they're actually either stagnant and they're underperforming. And then people are like, what's happening? It's like, well, we can point to that. So all that to be said, I think the market is quite healthy right now as far as like what's being rewarded, what's not being rewarded. Of course, we can point to pockets of debatability there. People point to Palantir right now as trading at, I don't know what times sales, and that's saying, hey, we have a lot of exuberance there. But at the same time, we're in 2021, which I point to as that's the real clown market. 2021, you had companies that didn't have any sales that were trading at crazy valuations, which is more reminiscent of the year of the dot-com bubble than we are right now. People are saying that we're now in the dot-com bubble, but I wouldn't say it's comparable whatsoever, because the AI companies that we like to point to, they actually have real earnings. They have real sales growth, real earnings growth, and they're not trading at 100, 1,000 times earnings or 100 times sales, ex Palantir. But they're trading at fairly reasonable, like even Nvidia is trading at 30 times forward earnings. So it's not comparable to the dot-com bubble. Now, if you conclude that the earnings projections are incorrect, then of course we can, have that separate discussion, but it's not comparable in my opinion. 2021 was a crazy year, and that's when you had shitcos rallying, solid companies also rallying, some solid companies getting to incredible valuations. I mean, you guys recall when I made videos criticizing people's valuations on companies like PayPal, people coming up with like $300 price targets, $360 price targets on PayPal. And I was like, where is it getting this? It's pretty insane stuff. I don't see that happening right now. That's not happening. All right, some of the other topics or bullet points that I wanted to talk about is it seems like the biggest winners experience also significant drawdowns, and that's pretty healthy. That was observed across time. So volatility is to be expected, and if someone is an individual stock picker, they're going to have to stomach that volatility. Volatility is not necessarily risk, although we take it as a measure of risk, but it also, well, technically it can be a definitive measure of risk, because maybe if you acknowledge that the behavior of the investor might change depending on the volatility, the execution risk becomes higher. So you're more likely to make a mistake if the volatility is higher, as an example. Now, this part, again, like what I took note down, but this should be quite obvious. And what I was trying to address earlier is that one of the main drivers of success for an investment is how much do they grow earnings? Pretty simple, pretty straightforward, right? But sometimes people forget that, right? I know that it's obvious, but hey, the study concluded that as well, or according to that, the data supports that. If you're looking at a basket of stocks and the earnings are growing, those should do better than the companies that the earnings are not growing, right? Fairly straightforward. So the points of diversification were also brought up often, and the limitations of diversification. So for the most part, a random basket of stocks does not tend to have any sort of material outperformance. Basically, if you're too random with your stock selection, you're going to basically get market rate return, but maybe more risk. So there is like a balancing act, and it really comes down to go figure. You kind of have to know what you're doing and take strategic risk. Because if you don't, then you're kind of just going to take on more risk than you're otherwise, bargaining for, and then accepting lower returns, which, in finance world, that's like, that's just taking an L basically. So again, fairly obvious point to take away, but, I thought I would say it anyways. And the other part that's kind of also interesting is what I said earlier. People think that the technology companies were the greatest contributors or greatest performers. No, maybe we redo this in 100 years from now, and maybe that's different. I don't know. But actually, over the past century or so, it's actually the most boring companies that produced the most returns. And then there's also the factoring in age as well. So even factoring in age, that's also true. Now, skewness, this is also important to note for those of you who are fans of international investing. Skewness also expands in international markets, doesn't contract, expands. So while skewness is expanding in the United States, skewness is already much more expanded in international markets. Basically, what that means is a very small amount of the stocks are producing the vast majority of the returns in those markets. So again, this makes the argument, right? You have both sides of the argument. If there's a lot of skewness, you should index. And then the other side, if there's a lot of skewness, it heavily rewards those who can find those companies, like heavily rewards. So the more it gets skewed, the more the reward potential. But the more they get skewed, you got to be honest, are you going to be finding those stocks is the question you're going to get down to. So if skewness is widening or is wider in a certain market, then, there is, if you just select a random stock, right, more likely than not, the majority, that means more of those stocks that you select are going to be duds or zeros than, if you just buy the basket, and then you'll get the performance of that market or so. So that should, that's the main takeaway that you should take from that point. The other point that I think is, also kind of to hit the nail on the coffin is the greatest contributor to wealth generation. And again, this is more of an obvious point, but just saying it out loud and just seeing the data supports this is time in the market. Time in the market does, in fact, lead to greater wealth generation. So basically what that means is the more time you spend in the market contributing, and if you're taking the consistent return, and that's also the point, consistency of return, then you get that more desirable outcome at the end of your investing journey. And then again, that volatility can be, added a problematic situation to, if you're retiring soon and then suddenly you get a spurt of volatility to the downside, that could cause a problem. But again, that's there. So I think that covers pretty much all the points that I really wanted to cover. And let me see if there's one that I missed out on. I guess this was also part of the conversation, but that family-run businesses or founder-led businesses also showed a bit of a tendency to have, over the period of time where they were founder-led, some significant outperformance. All right, so noticeable outperformance. I think, yep, that covers all the topics I wanted to cover. And let me check my written notes because I think we covered all those. All right. So yeah, that covers everything. So do stocks outperform treasuries? Yes, the asset class outperforms treasuries. However, among the universe of stocks, there's a very few amount of them that are winners. But again, one of the issues I have with the data set is that included in that data set, which is tons of stocks, is a lot of these biotech firms, energy firms, and a lot of them are going to be duds, extremely risky, et cetera. If you take, for example, the average company inside the S&P 500, I don't think that the average company in the S&P 500 will, let's take the equal weighting S&P 500. I don't think that's going to underperform treasuries. Will it outperform the market cap weighted index? That's a different question. That's a whole different question. But will it outperform treasuries? More than likely than not, yes. Okay. So a little bit of a eye-catching title for a study, and that's the conversation I want to have with you guys. All right, so let's talk about, let me see if there's any question that I'll star and we'll get to in the later part of this. What is that? There's protection against ignorance. Some old guy. Yep. Can I ask about your latest Google trade? Of course you can ask about my latest Google trade. Of course. Ask what's the specific question on it? And then we'll get into it. Doesn't matter if this is a public stream. I'll talk about it. Okay. So let's talk about JPM. All right. So JPM reported earnings recently. Now let's go ahead and put up their stock. And they rallied alongside with the market. We got some macro data that was quite positive too. But JP Morgan had some interesting things to say. So for context, we've been covering JP Morgan's earnings here and there for over a year now. And the takeaway, or the key takeaway that I want you to remember or recall, is that they have been bearish the whole way through. Oh, sorry. No, Ben, I'll repeat it. So equal weight outperformed treasuries. It's a whole different discussion if equal weight will outperform the market cap weighted. So I was basically saying that within the data set for stocks, right, we have a lot of companies that, like tons of biotechs, like you throw a rock, there's like a lot of rinky-dink biotech companies out there. There's a lot of energy companies, a lot of mining companies, and those are basically make it or break it companies. So that's one of the things I was pointing out as one of the issues, right? But if you take the average S&P 500 stock over a period of time, per the title of the study, does it outperform treasuries? And the quantity of companies that underperform treasuries, which are like the ones that go to zero, pretty much, I think that if you factor in or take that into account, the equal weight S&P 500 would outperform treasuries, right? Because you do have a filter of quality implied in just like the constituency of the S&P 500. That's what I was trying to say. I'm not getting into which one I think is going to outperform S&P 500 equal weight or market cap weight, separate discussion. Just that it will outperform treasuries. Wanted to say that to, clarify. Okay. So, all right, cool, man. I saw you close Goog, just took profits or any change of the fundamentals for you. Oh, I started, but Frank, I closed Goog. I guess, can you expand on that question? I closed what from Goog? The shares? Anything about Bob? I'm assuming your position on it is still the same. We'll answer this question too afterwards. All right, we'll answer it in the next segment, actually, for AI. Sorry, not AI. Wow, I'm thinking about AI all the time, guys. A Barrow, or we'll get to you. So JP Morgan Chase's earnings. So key takeaway or key remembrance, key point that you have to remember. I'm going to say key one more time, maybe 5 more times. I'll say the word key. Is they've been bearish the whole way through. They've been bearish for as long as we've been talking about Bank of America versus a JP Morgan. So JP Morgan, Jamie Dimon's coming out saying, recession, 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 cautious, be cautious, and be cautious. Bank of America has been like, I've never seen anything better. This economy is amazing. It's never been better than we've seen currently. So today, or sorry, not today, yesterday, JP Morgan actually comes out and is actually really optimistic on where we are. You've been seeing titles probably saying, we're here, soft landing is here. So some of the key takeaways that I wanted to point out is, we saw a strong, report on net income. We saw strong, on credit card service growth. So if you guys don't know, JP Morgan Chase is basically like the top dog, the number 1 or number 2 player in everything that they participate in. They're really an anomaly in the financial space. So they're either number 1 or number 2 in credit cards, or number 1 or number 2 in investment banking. They're number 1 or number 2 in commercial lending, on and on and on and on. So when we take a look at credit card service growth, we saw delinquencies come in strong. Strong is in a good way. We saw it, but keep in mind, JP Morgan also goes after the higher credit rating client base. It's people that don't really carry a balance, higher incomes, etc. We saw strong growth in NII income, although NII headwinds going forward. Really, Jamie Dimon got really upset with one of the questions that was asked upon him from one of the analysts, because it's like, we don't really give that kind of clarity. I say I'm not part of JP Morgan, but they don't give that kind of clarity for it. And it's not something that's really knowable. But the headwinds really are showing up because, the yield curve, right? Banks borrow in the short term, lend on the long term. So it does make it more complicated, not impossible, but more complicated to be certain about what the future outcome holds. So the other point is, I think what JP Morgan was penciling out for the longest time, again, is that cautionary take on the whole economy. There was, we were seeing rampant inflation, consumer price rejection. What does that mean, consumer price rejection? Well, consumer prices can go up as long as consumers accept them. Then once consumers reject higher prices, then you have, signs of a problem. We can call that a couple ways: demand destruction, etc. And so JP Morgan Chase, previously, a lot of their concerns had a lot of merit. You listen to Dollar General, they tell you, hey, the lower base bound of consumers, they're struggling. You listen to Walmart, they say something similar. You listen to Target, they say something similar, on and on and on. And then so we also had counterpoints, right, that discussed, okay, well, maybe we had a rolling recession. What does that mean? That maybe we were already entered into a recession, and then different parts of the economy are experiencing the recession in a different way. Oftentimes when we have a recession, we don't call it a recession until after the fact. Fun fact. So for example, 2008 recession, we didn't call it a recession until a couple, I think it was over a year after. Then you could even go back in time, not go back in time, but go on YouTube and see the news reports, and you can see when they declared it a recession. They went, news anchors went on TV and said it's officially a recession. And then they say, oh, these people, blah, blah, blah. They said that the recession started here, right? And so that's oftentimes how it happens. It could be that that's the case. And I wrote for club members. I wrote a kind of like a letter to club members, right? Letter to shareholders of sorts. And so in that letter, which I publish it sometime in the future, but I'll take one of the key points that I wrote about, which was about expectations on recession. So I pointed to my personal stance on the investment approach is I'm going to be more cautious on investing in consumer discretionary. Right. And so my portfolio doesn't really consist of many I don't have any consumer discretionary names. So I don't really have that exposure. But the also call to action was a reminder to all the members who are reading it, and I'll say it here publicly, that there is a expectation that because of 2008, we have this remembrance of what a recession, is on the extreme level, but that's not how most recessions are. So if you read back into the history of things and go back to investors after, the Great Depression, a lot of investors were scarred from that. And so they had pretty pessimistic expectations. So if you look at there's a measure, I forget what it's called, but for the sake of just continuing the conversation instead of me looking this up, you can look at the optimism versus pessimism of each generation. And so the people who grew up in the Great Depression for the rest of their lives exhibited signs of greater pessimism than those who grew up during the time afterwards. So the baby boomers were quite an optimistic generation. I know that we have the term on the internet called doomers, right? But realistically, the baby boomers were actually quite an optimistic generation. But the generation before that was a quite pessimistic generation. So they were more likely to think that there was a crisis looming on the horizon than not. And so that also was reflective in their investment approach too. So people who lived during 2008, maybe they're going to experience the same thing, right? They're going to, think of the millennials who were kids and saw things, or maybe teens and saw things, and then younger adults and who at the time were investing. So they might have this different approach or view on what a recession is like, but they didn't live, prior recessions. And so when you look at and listen to some of the older folks, they'll say, yeah, I lived through this recession, and oh wait, that was like Armageddon. And then you hear about how they feel about, the economy, for example, and it's more optimistic. So I think that kind of goes to show that experiences shape our decision making, right? Oh wow, I said something so profound and new and novel. No, it's very obvious. So that being said, is that one of the key calling points in the letter to the members was, hey, just be aware that, there's a lot of pessimism out there, and that the recession most likely is not going to be like '08. So a lot of people are like prepping to try and time the market. We did a live stream. I think the last live stream we talked about was about, people who are kind of clownish and they're trying to time the market. I think Meet Kevin's called for a great crash like 17 times this year, jokingly. I don't know how much it actually was, but we'll say a joke 17 times. And how fruitful is that? Not very. We also talked about within the club about the September slump, right? Where everyone was calling for that. And so we were probably not going to get one. So you go long beta, right? So you just go long the market. Now's the time to buy, because you had I'm not trying to be mean, but like the old adage of like when the shoe shiner starts telling you things, you do the opposite. So if the shoe shiner is really bullish, you should get bearish. If the shoe shiner is very bearish, you should be bullish. And so in this case, for that, metaphor or comparison, the shoe shiners were saying that September was going to be a crash. And then we made a call that's saying it's probably not going to be the crash that you think it is. We had the yen carry trade and all that, but that was very short lived. And then we had a very strong September. We're having a very strong October. They're all calling for a November run. They're calling for the Santa rally. So maybe that's like to be cautious. But no, Meet Kevin is still, whatever. So as long as he's in his place, we're good to go. So that's the gist of JP Morgan Chase. Overall earnings were really good, really optimistic. Wells Fargo also fairly good. We saw an income come down a bit, but the guidance was what people were paying attention to. And so if we have this soft landing, all the other things about NII margins are all going to settle themselves out in the future. That pretty much covers that. All right, so let's see if there's any new questions. People who grew up in recessions are the people at Costco grabbing all the chickens. That's true. Yeah, that is true. Let's see here. Do banks like JPY really borrow at the short term, since they have deposit accounts paying virtually 0% and material to their lending on the long end? It's not very material. JP Morgan is it's an anomaly. JP Morgan is such a unique situation. So the duration risk at JP Morgan Chase is extremely low, and the credit risk is extremely low. What do I mean by that? So even when they acquired First American Bancorp, FRC, when they acquired FRC's assets, First Republic, not First American, First Republic. When they acquired their assets, they took on a lot more duration, but very low credit risk. So it's whoever could swallow up those assets. It was like picking up dollars for pennies. And you just had to have the liquidity, and JP Morgan had more than enough for that. So even with acquiring those assets, their duration risk is actually quite low. I think they have an average duration, last I checked, between, I'll just give a range so I'm more accurate. I'll sacrifice precision for accuracy. It's between like 7 and 10 years. So that's really low. Bank of America's, by contrast, is like 20 again, range for accuracy instead of precision, between 20 and 25. So it's very long. Actually, I'll give it wider, so I'm even more accurate. It's between 19 and 25. The point is, it's quite long. I haven't brushed up on it in a while. I imagine it hasn't changed all too much. So, yeah, with all things being said, the JP Morgan, even in that, is extraordinarily rare of a bank. It's quite literally the best at what they do. They're the best at everything. It's pretty crazy. So they have the most room to expand and contract their balance sheet. Now, you didn't ask about this, but I'll say it anyways. Wells Fargo, on the other hand, they've been actually cleaning up their balance sheet because of the asset cap. And that's actually one of the things I've cited in the past about being kind of bullish on Wells Fargo, because if the asset cap gets lifted, they have a lot of high quality assets on their books. So they can afford to really expand that balance sheet more so than some of the other banks. Bank of America took a lot of duration risk. They don't have much credit risk, but it's a lot of duration risk. And so that really cripples their ability in some cases to really expand. So if there is a liquidity issue, one of the biggest banks with the greatest risk is actually Bank of America. Risk, not a guarantee of outcome, but it's just like a risk. JP Morgan, on the other hand, it's like there's no risk. Well, not no risk. They have the least risk of the money center banks, the least. Okay. So exposure pointless when you can just get bonds and preferred shares for a higher yield with relatively the same risk, specifically talking about SOFR. Yes and no. Well, to us, yes, but to a bank, no. To a bank, it's always going to be, and especially in terms of like the size and scale that they're at. The market, like if you're talking about preferred stock market or the preferred shares market, it's not liquid enough, and it's not vast enough for the amount of money we're really talking about. And it comes down to minimizing the risk, the credit risk, as much as possible. And then if I can have a guarantee rate and then leverage it up as much as I can, you take that. And if you can generate a spread on that's where you're playing the right game. So I got a super chat bump. Fuhad asked, why didn't you keep JPM? You know what? I was silly for not keeping it way back when. But we did fine without it. But yes, for those of you who don't know, Fuhad is one of the JPM chills in the club. He loves JPM, and he goes like, we could have been JP Morgan brothers, but you got out. Yes. So apologize. I'm sorry to disappoint you, Fuhad. What about Carvana outperform? Yes. No, all of us are actually clowns because we actually could have just bought Carvana. All this work we do, all of this effort we put into things, all of it means nothing. Look at Carvana. Just destroyed us all. Disney, is the mouse dead? Well, they burned about $200 million in a stupid show. Okay, the stock market is pro-cyclical because of the wealth effect. What do you think about that theory? High stock market equals higher inflation / growth. Yes, no, I absolutely agree. Like one of the things that the Fed cites in their research is that through their policy, they can more directly impact the multiples by which assets trade at. And if they can do that, they can indirectly affect the economy via the wealth effect. So that's something that they themselves say. Okay. Because there's not a direct link between Federal Reserve action and the real economy, as we say, so consumer spending and the like. There is an indirect effect, and the closest direct effect that they have is via the wealth effect. So if they can have a positive effect on asset prices, then they can potentially increase consumer spending, and then that consumer spending again then filters through the economy and can cause demand-driven inflation and the like. So, and yes, it works to the downside as well. Exactly. Very good. Always dollar cost average. I added 4 shares of VU per month. It's my base go-to. Absolutely. No. And it should. You will never do wrong with doing the vast majority in a broad-based index fund. Okay, so that covers the discussion on JP Morgan's earnings. We're going to get more earnings as we go. I think Bank of America reports on Monday or Tuesday. I think we have a holiday. I think we have a bank holiday, so they might be reporting on Tuesday. I can't recall. So my memory's fading me on that. Okay. But yes, for DOMs, yes, it works the other way as well. So if stocks are down a lot, people might be like, I don't want to spend as much. Okay, let's talk about the China discussion, and then we'll finish off with all the questions that we got. By the way, keep asking your questions. I'll try to star them, and we'll get to as many as we can get. Well, we'll get to all of them, as much as I can. So I had a question. I'm pulling this one up, so it's not because I'm playing favorites here, but it's because the next topic is about China. So BABA and all the like. We talk about BABA a lot because BABA is the most popular. So I'm not going to make any dedicated videos, kind of poo-pooing on these stocks, but I will say or add that nothing has changed as far as my opinions go on these Chinese companies, and I'll repeat this. There's videos, you can go watch them. And I say this is what I fully expect, that the CCP, the Chinese government, will coddle Western investors. Well, what do they just do? That was basically a coddling of sorts. And so I maintain that view, but I also maintain my view that the fundamental value of these assets is near worthless. So continuing forward, if you see sentiment shift downward again, so I'll say it once more, if that happens again, you will see the CCP coddle the Western investor through some announcement of some sorts. They did this while we did videos. Like I had a video that I made, I think in 2022, and the call, not the call to action, but the predictive take on the video was, okay, the sentiment is pretty low. The CCP at any point is going to announce something to coddle the Western investor, make them feel good, to improve sentiment. And I think it was the very next day, which prompted me to make a follow-up video, because it was the very next day, the CCP announced measures, and then you had all of them rally. I think Alibaba at one point got to near like $120. We even did a trade for fun where it was December of 2021. We talked about doing some sort of trade on the sentiment, right, of China, with a tiny percentage of my portfolio, because if I fundamentally believe in what I'm saying about the valuation, or the true value, the intrinsic value, I would never, even dare risk something crazy amount of my portfolio. So the China stimulus, while entertaining, making for interesting news, is, in my view, does not change the fundamental conclusion that the Chinese VIEs are inherently worthless instruments. Well, correction, they're not worthless, because there is a potential for regime change at one point in the future, and then the changing of the structure. And if that happens, then all bets are off. Your take on Europe and going long the euro. We'll talk about that. Well, let me star your question, Fuhat. Europe is doomed, and he's European, so I'll add that Milk Shakespeare is European. So he's not an American saying that. If any Europeans get mad, he's also European. So that it's a pretty short topic, if I'm being honest, on covering Alibaba and the China stuff. I'm basically saying that I don't really feel enticed to make a video just yet, because they're still down a lot. I will feel the rush, the excitement to make that kind of content again if Alibaba and the like and all those companies recover to like at least $200 a share. Then it's fun to make the videos and talk about why there's a risk, etc. That's why I didn't really make a whole like massive series while Alibaba was like at $60 at one point. It's just not fun. It's fun when it's up, and then you talk bad about it. Right now, it's still not fun. This is like the meme of the guy being impressed by the chart, and it's like, oh, it's up, and then you zoom out, and it's like, well, let's zoom out right now. So it's like, it's not fun to kick the stock necessarily while it's down. It's more fun when it's up and you kick it, and then it goes down, and then you're like, okay. But making a video, down here is like, nothing's changed from my older video. So why make a video repeating older content or points? Just go watch the older video. Okay. So, Bob pays a dividend, so don't you at least get a contingent claim on the cash flow? Yes, but for my view, and I maintain this, it's all basically a token gesture of sorts. At the longer term, you're going to see still that there's certain behaviors and actions that don't really quite sit well. If I'm being honest, there should be like an immense quantity of share buybacks right now, given the, and it doesn't add up, right? It like doesn't add up. If I see that in other foreign companies, I would never give them the same excuse that China seemingly gets. So you get massive, supposedly, and I'm assuming all the numbers are correct, massive cash flows, great balance sheets, phenomenal balance sheets, and they're not completely and utterly devouring the share count. Like they could do immense damage in theory, but they're not. It's like they're holding back, but like why? It's kind of weird. And then they issue, convertible notes. I'm like, why? You didn't even need to borrow. You're producing supposedly tremendous amounts of free cash flow. So my skeptical side just says like, why are you doing that? And I apply that with any company anywhere in the world. So I'm not only taking that approach to Chinese companies. There's companies in South America that are kind of questionable with how they do things. So I maintain my point. Everything and anything from these entities, because you're not really an owner of anything. And again, there's case studies that get into that, or actual court cases that get into that, where the journalists who cover it in the West, they get confused and like they're like perplexed by how a Yahoo can just get spat in the face by Alibaba, and they can just take an asset away, and they're like, what? How can you do that? Because you're applying a Western normative mindset to a different market. And by the way, I have a lot of members in the club who are Chinese, and they really appreciate this take. And they themselves are sometimes the largest proponents of like not investing in China, which is the funniest part. So like some of the greatest defenders are like Westerners who are like, yeah, China, blah blah, the greatest defenders of it. And then I'm sitting there and I'm listening to some of our members who are of either Chinese descent or like first generation immigrants of China, and then they're like, no, I would never touch this. I'm like, wow, that's really funny. That's like really funny. And then you have on the opposite side, I think one of the greatest defenders of all these that I know of is like lives in like California. Is American, completely Western raised, etc. And it's like it's very fascinating to observe. So yeah. Yeah, it's funny things. All the wealthy Chinese fleeing the country. Yes, no. That's the funny thing. So that's why I always use, and it sounds like I'm a college professor. Like Western normative narrative, Western normative mindset. It sounds like super narrative, but no, I'm trying to describe it as like an approach to investing that you should be aware of your biases. That's the broader message. You should be aware of your biases. You should be aware of your lived experiences shaping the way you think, and then trying to say, okay, I live in the West where the rule-based system is like this, and this is how the system works. Am I going to assume that that is how the rest of the world works? Or am I going to accept, not get mad about it, but just accept, come to terms with that every country is going to have some differences, and you have to learn about those differences, accept those differences, and then make your decisions around that. So just accept that in China, things are different, right? And you just have to navigate through that. So that's what I mean when I say the words Western normative mindset. And that's the same thing. I see that people apply that to Latin America a lot, and they get into some mistakes a lot, right? They get into some pickles for sure, because you're applying Western normative mindset to Latin American businesses, and then you're unaware of the risk you're taking on, and then you get blown up. So Fabio, they are naive about how business works in China, how you can't succeed without bribing people. Yeah. Okay. Thank you. Okay. Thank you for bringing this point up. Exactly. That's like one of the things. And then same thing that's underappreciated in many Latin American markets. So it's like, you do business here in the United States, and you're like, wow, there's a lack of this that you could find it. I'm not saying you can't find it, but you can find it for sure. But it's not as rampant. And so it might be like a culture shock to you. And imagine you're sitting in your chair on your computer, thousands of miles away, and then you're making a decision that has a real world consequence, and then you're unaware of the risks you're taking. That's the crux of my point here. Okay. So, oh, we can talk. I'm starring. By the way, if you're getting any comments or questions, I'm starring them, so we can talk about them later. I say your comment about potash. Okay. So I think we're now getting into the. What is happening, Mr. Misty? Doing see camera. You know what? We'll start with this one as like a break from the topics, and then we'll get into the other questions, because this is just more funny. So let's talk about what's happening with MSTR. All right, so this is the mental break, so less serious, but let's talk about what's happening with MicroStrategy. So MicroStrategy made some announcement, to my knowledge, that they're citing the future potential of the company kind of becoming the first Bitcoin bank, right? And so this company trades at, I think it was like 2.5 times or 2 times the value of its Bitcoin. And it's basically an exposure to leverage Bitcoin. They borrow money. They have been borrowing money to then buy Bitcoin. So Bitcoin bulls are saying, I could buy MicroStrategy, and then they are basically managing a portfolio of Bitcoin on top of everything. And then, yeah, for sure, there is an incredible amount of hype behind MicroStrategy. I can't justify the valuation. If you, depending on who you ask, you have a worthless token that they have real money into, and so it better hope that the price of the token goes up over time inconsistently for whatever reason. We're not getting into the debate on which side I think is right or wrong. You might have you might know, but well, actually, I'll tell you, I'm agnostic. I don't give a shit about what happens with Bitcoin or not. I know that for me, I'm going to be fine in life, and I will just request or require from my assets that I generate whatever the currency is. I'm not willing to take on the risk. I don't need to take on that risk. I don't need to throw any money at it. I don't care about it. So if Bitcoin becomes the de facto, form of currency, I have a video of me talking about it, that I'm somewhat like a sideline cheerleader. Like, conceptually, the concept of it can seem interesting. How it can be something like it, akin to it, can be used to combat authoritarian states around the world, right? So there's some aspects behind the philosophy of Bitcoin that it's interesting. And then you can't also reject or negate the history or the use of Bitcoin in some of the more illicit parts of our society. So yeah, but long story short, I can't tell you what's going on here with this valuation. All I can say is that I would not be comfortable holding this. And so Misty versus MicroStrategy, of course, you're getting underperformance with Misty, but he's looking really smart right now. Of course, he has no idea what he's doing, but he's looking really smart right now because he has one of his portfolios. He borrowed money against it and he threw it in. And by the sheer luck of the stock market, it looks like he's going to come out on top if he were to sell everything right now. I have no idea what it's going to look like a year from now. But, right now, animal spirits are alive and well in crypto. So, okay. Now let's get to, I have some more stars. And let's bring this one. Cope and Seed. Tractor Supply McDonald's at 300. Cope and Seed. So, yes. For full context, Dan actually pitched Tractor Supply at a much, 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 much lower price. I'm trying to remember off memory like what price it was, but I think it was around yonder. It was definitely under the 200. I think it was here in 2023. Yeah, it had some stellar performance. I know it was on one of the dips. It was definitely on one of the dips. So congratulations, Dan. And he's also a long-term holder of McDonald's, which recently passed $300 a share. Look at that, like just almost like obvious buy dip. I had a bet with Fuhat, which I won, basically that it would go over $300 by June of 2025, and he owes me a Chipotle bowl, which I'm kind of getting hungry. I'll probably be hungry this week, Fuhat. Just saying. So a little reminder, a little, the payments coming due. Just messing. He pitched it under 200. Okay, so let's I gotta start your second Oh, this is another whole question. Let's talk about that too. All right, let's start getting into the start question. So let me remove the one I already answered, and let's go down the list. All right, so first question. Thoughts on gold outperforming the S&P 500 year to date and since 2022? So funnily enough, right, gold has been going through a tremendous rally. If you look at the junior gold miners, they've been doing really well. I think that gold realistically has basically just been catching up to what the price action of other assets have done. So I don't really think it's like a gold bubble per se. Let me show you this chart that I think you'll find interesting. Okay, so hold on. Let me be nice to this website. I'll disable my ad blocker so that they can feed me crap and I can get their stuff that they're giving to me for free. So I'll appreciate them. All right. Let me share this tab instead. All right. So what I'm showing you here is the gold price actually adjusted for inflation. So we're seeing the real price increase in gold over the years. What you start to notice is that the price return or the actual net return of gold hasn't been that great. Let's start off with that. It hasn't been that great. But it's done something. It at least has protected someone's wealth over the very long term and then given you a little bit extra. But the volatility is a fair bit concerning. So it doesn't actually protect you from the volatility, but it does give you at least some growth. You are experiencing some growth. But I want to highlight to everyone, just like how underwater you are. This is what's interesting: how underwater you are if you bought gold after the decoupling of gold. You've been underwater in real value for a very long time. You're just basically, if you bought at the very top, you're only just now recovering, like kind of like the Japanese stock market, right? So there a lot of only in recent history have you basically recovered from that. So, it is something interesting. So you had this massive run to bidding up the price. And of course, if I show you let me show you what it looks like without adjusting for inflation. Let's go back far enough. This doesn't go back far enough. Hold on. Let me get the full year. Here we go. I want. Oh, I can just actually right here. I didn't even see that. I had a box there. I could just unclick. Makes it a lot easier. So this is like in the nominal term. So the price of gold has gone up and up and up and up to the right, basically. But again, when we gold is typically thought of as some inflation protection, which it has to an extent, given you that, and then a little bit. But there have been definite times where, adjusted for inflation, it's been a bad time. So like if we kind of trying to see, gold price in nominal terms also went down all the way to the year 2000 from the peak here. But if you're trying to be more honest about it, the measure from here to here was quite significant. Okay, so you did actually make a tremendous amount of gain if you were purchasing gold prior to the decoupling of gold, and then you looked at the low of 2000. So in nominal terms, and then even in real terms, once again we go for inflation adjusted. There is a non-insignificance if you timed the perfect bottom and then you look at where you are today. Like you did fairly well. Like it did its job at protection. For full disclosure, like I have nothing against gold. I collect gold as like a hobby. Lost it all in a boating accident, but if I gold's fun. Gold's great. There's something primal about collecting, rock. And strongman, if you're watching, yes, shiny rock. But no, I'm fully aware. It's probably a bad use of capital. Obviously, optimizing would be better, you know, in the stock market, etc. I don't think it's a major, you know, percentage, but you know, hey, there's something primal about a man having, you know, completely theoretical place where they store the gold, maybe a bank vault or something. You know, you go, like, hey, I give you the key, and you go and you take out your gold coin, you stare at it, you put it back in the box, you put it back in, you leave, you give the key back, or they escort you. You know, there's something primal about that. You can't be replaced, you know? Anyone else feel that way? See, I imagine some of you are nodding and some of you are like, what the fuck? And some of you are like, yeah, I get that. That's me. But no, in all seriousness, yeah, gold, what are my thoughts on it? I think it's kind of, if we look at it here, it's basically just like recovering. So it's jolting back up. So you see it's recovered right to where it was in 2020. I look at gold in just like real terms. And by the way, you take this approach too, and you do the real adjusted market return. You know, I implore everyone to do the same thing or take the same standard of inflation adjusted return to your equity investment, so you can see what the real gain in wealth that you've had. So it's a negation, in my opinion, of the stock market's in a bubble. When you really look at things with more nuance, no. And again, all those arguments are just FUD to keep you from dollar cost averaging into your index funds, which you should frankly just ignore. So I don't think stock market's in a bubble. I don't think even paying attention to that is fruitful or a good idea. You should just keep buying into it. And so all these arguments, I've hoped, you know, since the very beginning of this live stream, I've helped, you know, at least shed some counterpoints to that. This one is not the main counterpoint. There's other counterpoints to why we're not in a bubble, but like, you know, also take some perspective, like what 2022 was, and then even adjust the inflation return from 2021 to right where we are now. How much higher are we, you know? So I wanted to add that perspective. Okay, so more questions. By the way, if you're asking questions, just to be kind to everyone in order, I'm just basically putting a star on it so we can get to it. But I'm opinion investments for chasing brown hill success. You know, switching dividends to weekly and options. All right, so I'm putting stars. Gold recession. Yeah, no, not that. Okay, so that question answered. All right, Ingalls. I remember you held it once a few months back. Yeah, so I currently do not hold Ingalls. I know that Ingalls actually fell recently because of the hurricane. And so I am KTA. I'll talk about them. And so we've been actually bringing them back up and doing some research on them. With Ingalls Market, there's a very interesting value proposition just based off of the real estate value. So they have a very low amount of leverage. And then with that low amount of leverage, it makes it fairly interesting because the real estate assets, which are under leveraged, and let me break down how much leverage this is. They have about $500 million in debt and about $350 or $380 million in cash. This is the most cash they've ever had. And they go through periods of time where they do a crazy amount of buybacks. Right now, they're going through a CapEx cycle. And then on top of that, we have this uncertainty with the hurricane. I think that this might actually be presenting an opportunity to add into that uncertainty and then kind of plan out, you know, like an allocation percentage. And then if it continues to go down because, you know, we get more clarity on the earnings being lowered and maybe it's worse than we thought, then you have some more room to add. But then this could actually just be the temporary bottom and it continues rallying and they might actually start initiating buybacks. So if they do, they can really do damage to the share count. This also has some, it's not all sunshine and rainbows. So there are some concerns about Ingalls. Depending on how you feel about things, it may be a bigger concern or a lighter concern, but Ingalls has a strong insider ownership grapple by the founder's son. And it is his company, so it's all within his right to do whatever. So I'm not going to, you know, you have to just accept it. And he does pay himself a lot. He pays himself, well, not a lot. He pays himself double what the CEO makes. Although it is very unclear how active of a chairman he is, because it could be like a co-CEO situation where he doesn't have the title of CEO, but he does a lot of things that act as if he is the CEO. And then he has this CEO guy that's, you know, the other CEO. So if he is taking a more active approach, then, and if you find that out, then maybe you can justify him getting paid that much. And also the fact that, yeah, it is his company. It is bonuses. So he gets paid like $6 million, at least the past 2 years. He's been paid $6 million. The CEO on his bonus has been paid like $3 million. So they have actually, though, grown the book value per share. So they've actually increased shareholder value. There is a token dividend that's applied to the stock. The token dividend is honestly just there to pay the founder's son. Like that's like an extra bit of bump for him. They never increase the dividend. The dividend is just flat. But they have done periods of share repurchases, typically around the current valuation of where it's at in terms of price to book. So they're quite selective. They don't just buy stock all the time. We've seen stocks like Sprouts Farmers Market that which I would not be interested in Sprouts Farmers Market now, but this new CEO comes in and he basically takes this new approach of increasing leverage and then doing share buybacks. And so this is what you can get, especially if you're trading at single digit multiples. So right now the multiples expanded quite drastically. And if you actually look at what's happened, the earnings haven't grown that much, but the earnings per share have grown simply because of the sheer quantity of share buybacks they've done. So they've increased the leverage and they've done basically like a leverage buyback. Ingalls could probably eventually take something along those lines with way less leverage. They could elect to use a lot of leverage because, again, they have a lot of the real estate directly owned and, again, with very low leverage. So that enables them to do maybe like a sale leaseback or stuff like that. They'll never do this, by the way, but they could do it. Sale leaseback. At the very least, they have a lot of cash. So that's actually where a lot of the capital could come from. So the enterprise value is well under $1 billion. Sorry, no, it's not well under $1 billion. Yeah, because they have a net debt position. So scratch what I said there. But I don't expect them to pay down the debt early because a lot of the debt is tied to real assets. So they have a really low cost to borrow. So with all that being said, after the hurricane and this damage, it is getting interesting again. I mean, I might get back in. It's just there's other ideas that I find really compelling. There's some club members who like already have started accumulating shares of Ingalls for full disclosure, but I can see how it really works out. So good for you to point this out, Christopher. So shout out to Ingalls if you guys are interested in that kind of company. Some other things to point out. One of the most important metrics or KPIs to look at when you're looking at a grocery store chain is, of course, like inventory turnover. So margins are low, but if the inventory turnover expands, then you actually can produce a lot of net income. So that's really the underappreciated secondary KPI that you want to be paying attention to is inventory turnover. Inventory turnover at Ingalls Market is going to be on the lower side, but they, for example, compared to a Kroger, I think Ingalls off memory is like it's like a 9 or 10. And then a Kroger off memory is like 15 or so, 14, 15 or so. So when you look at that, you're like, oh my God, this company's like crap. There's some extra context that needs to be added. Go figure, more nuances applicable. Ingalls does own some assets like they produce their own milk, they produce their own cheeses. And so that can also fluff around the inventory turnover figures and make them look worse than what they might actually be. And then, for example, it should be obvious that Walmart should have a higher inventory turnover because they're not just a grocer. Grocers should have a higher inventory turnover. But Walmart also sells a lot of non-perishable goods, TVs, video games, etc., anything, toys, clothing. Walmart sells all of it. So the inventory turnover should be quite low. Costco is an exception. Costco has a very, very high inventory turnover. They are the exception to the rule. And that is kind of why the market loves them. That's one of the reasons why the market loves them. So, yeah. Yes, I did cover this one, and one of the stocks that performed the best, Vulcan Materials, Altria, etc. Yeah, yeah, but it was a good thing to show that some of the most boring businesses were the best performers. Okay, let's take a look at some of these other questions. Oh wait, there was one more follow-up. Ingalls price to book is 8.3. Oh yeah, it does seem crazy. No, but it's had periods of time like this. This is one of the lowest it's been. Of course, they just had a natural disaster. So maybe, I just realized I was still sharing gold. Apologies. Maybe now's the interesting time to buy, because you're buying into a lot of fear, right? Maybe it could be. So once I exhaust all my main ideas and this is still around this price, I would definitely take a gander. In fact, I almost like I told the club member that I'm living vicariously through him, just because I don't have the spare capital right now to because I'm making a large purchase. I don't have the spare capital right now to invest in another non-core idea. So it's like it's tough. So, but he's buying it, so I'm like, I'm living vicariously through you. I hope it does really well. So yeah, we can talk about TLN. So Talon Energy, a company that I've recently gotten involved with. And it's pretty interesting company and setup. So basically, I'll give you the spark notes and an elevator pitch on it. So they're a wholesaler for energy, and they have one particular asset that's a nuclear power plant. Nuclear power plants are notoriously expensive, and they take a very long time to build out. So rough estimate of what a nuclear power plant can cost, it could take you about 12 years on the, what we recently saw. And then it's actually been a short, or we can probably get in an optimistic scenario as short as 5 years. Still a long time to bring a nuclear power plant up online. And they're notoriously expensive. So the cost is about $20+ billion. So you have an asset here trading at $8 billion, low leverage. They actually came out of a bankruptcy. A lot of this was the gains that you experienced here was them actually switching exchanges from the OTC onto the NASDAQ. So a lot of investors could not even invest back here. And so that was a lot of the price appreciation there. And then going forward, there's some really interesting numbers you can pencil out about how much gains that there potentially are here. And that includes, the cash flows from the agreements that they're getting with companies like Amazon. And if they can pencil out a lot more of those agreements, you can get a higher predictability of those cash flows. They're trading at under 10 times forward cash flows for 2027, depending on what estimates you use. There are two issues going on right now. One is the issue about, hold on, let me just answer this. Okay. The two issues in question, you have the first issue, which is the lawsuit or complaint by the regulated utilities making a claim that if they were to sign these agreements, you're going to have a massive increase in price on electricity for their customers, and so that's not fair. So if it ends up getting challenged, then you get some increase in the uncertainty around those future cash flows. There are other bit of news that recently happened, and in part due to those complaints outlined. You have the auctions that have been delayed from December up until September. And these auctions will dictate the price for 2026 and 2027. So it hasn't actually affected the actual numbers or the outcome of those numbers. In fact, it actually may increase the eventual auctioning prices. But it's just delayed the timeline, and so it's added uncertainty, and so that's a huge part of why it's been selling off. And additionally, I mean, when a stock goes up the amount that it does, it's gonna have some violent pullbacks. You have violent upswings, you're gonna have violent pullbacks. It's perfectly normal. So for full disclosure, within the club, I have a position in Talon Energy. I'm not playing it maybe the way some people might think I'm playing it. It's not, but if you're curious as to more about it, you can join the club itself. So, but yeah, I have this full disclosure exposure to this. All right, so I believe I didn't get a follow-up question on this, but I haven't sold my common stock of Google. I haven't touched it. I believe FRNK may or may not be referring to the position I have within the holding co, again within the club, that I took off one contract. So I'm comfortable with talking about it publicly. It's completely fine. But yeah, I took off one contract on Alphabet, and then I'm going to be rebuying a contract, just like a different leg of the contracts. So because actually Alphabet came back down. So I'm going to take advantage of that. But I'm just basically was reshuffling, not a bearish stance or anything like that. So that's the only recent sale that's happened. Okay, so this is a separate question, but no, yeah. Options are not an option. Options are not necessary to have long-term success, but shares are, have significant upside if you just understand what the risks are, and then you allocate appropriately to that level of comfort for that risk. Because there are things that can go wrong. There's a lot of our club members who are like really bullish on TLN. And have been and are basically averaging up at this point. But there's also, a lot of things that could still go wrong. And the volatility, remember what I said earlier in the live stream, volatility in and of itself is not a risk, but it could be a risk to your performance in the sense that it causes you to make mistakes because you cannot ignore psychology. And so let's say you make an initial correct prediction, but the volatility is absolutely insane. And then it causes you to have poor execution on that idea. You then can, experience a massive underperformance of your goal just because that volatility occurred. So, yeah. All right, let me try to get through these because I am running up against the clock here. I think there's some interesting European companies. Sorry, I'm going through the questions. Sven just recommended MOS and NTR. What is your opinion on these cyclical potash companies? I have no business investing in them because I don't understand what cycle we are or where we are. It looks like they are on the downtrend, so they have come down quite a bit. So someone who is more, understanding of what the cycle of potash is, there are club members for sure who I would point to and be like, I'm going to ask them the questions because they're more familiar with it. Where we are in the cycle, yeah, there's probably decent money to be made. I probably like just everyone else in the mining industry. When times are good, they do the wrong thing, as in they kind of just buy back their stock at all-time highs. And then when times are bad, they have no cash. So I typically stay away from them. But no doubt you can make money. What is happening with MST? Oh, we already answered this one. And I've always held a 50-50 split between the SPY and QQQ. And we're thinking just going 100% QQQ because most of the stocks in the SPY have 0 to no returns. That's taking a huge tilt difference. I think that the S&P is still going to, or like a VTI is just going to capture, and that's fine to have it, because the QQQ, there's no guarantee that it will, by its constituency, outperform in the future. Be careful with recency bias, but I understand the desire to do it, right? And just look at the constituency, and you can make a judgment call. I mean, I think you'll do fine with either. It's not like you're gonna be in the poorhouse by any stretch, and you'll do fine. I'm not doing that strategy all in QQQ is stupid. No, I mean I think you will be fine. Risky, depending on your definition. I'm going through the questions fast because I am hitting a time crunch. Why would you implore me to buy more high tide? Depending on your allocation, because some people are comfortable with like an all-in approach to high tide. I'm not there yet by any stretch of the imagination, but I need to build out a more respectful position in high tide, or I want to. But we'll see what happens. So it just depends on your current allocation. Opinion on yield max, mostly for chasing round hill QDTE success on AUM by switching their dividends to weekly, and opinion on these 0 DTE ETFs. I tend to not like these kinds of products. I don't feel like they have really a place. And real quick, before I forget to mention this, by the way, I'm starting to ramp up videos again. Like I'm going to start producing a video schedule. So I'm going to do it like I did in the old days. I would love for you guys, if you guys are, I think some of you are in the club. If you guys are in the club, I'm going to basically implore everyone, just post the tickers they want me to cover, and I'll make public videos about those. I'll do priority club. If you comment on YouTube, I'll kind of add it to a list again. And then that way I'll get a whole list of videos out there for you guys, and I can basically start covering these stocks individually and then put out videos. I'll give you my opinion on it. I'll go through like a small evaluation on it. So I really want to get that that those out there. So I'm kind of getting into a phase where I can more properly schedule these things. And if I have that list to kind of go boom, 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 through, we're good to go. It'll be like, again, the old days. I don't edit my videos, just one take. So it doesn't matter for me. But I'll do like totally by your guys' recommendations or questions. All right, but anyways, let's get back to this one. So yeah, I'm not a big fan of them, Millennial Investor. So I don't really think that they provide what is important, which I think, especially if you're a millennial investor, should be total returns more than anything, and then income just will become a natural consequence of your total returns. So let's see through here. Okay, so I have some questions. All the lawsuits and Google had no meaningful pullback. Yeah, I know, right? It's like, dang, because I would want it too. I'm on your side there. So, but I think Google's it's a decent value, especially for its peer group. But there's a lot of other stocks out there, like the universe of stocks. There's a lot of interesting opportunities currently in the market. Okay, alimentation custa, for you French people that are proud of me for saying that. Thoughts on the current, or I'm sorry if I didn't say it properly, so don't hate me. Thoughts on the current acquisition proposal of 7-Eleven and if there is an opportunity here. So I actually don't like the acquisition of 7-Eleven. I think they're biting more than they can chew. Maybe I'm too pessimistic on it. Some of the bulls pointed out that they have the best management team in the industry. And so if anyone can make it work, it's them. One of our club members, he kind of did a beautiful breakdown of the efficiency per store between each of the companies. And then we kind of mapped out, or he mapped out, like what are the potential improvements if they can even meet half of the improvements, and there's a lot of return if they can even get half of it. So I can see it, but I think it's too ambitious. There's other franchises I think they could have acquired and then gotten a similar, if not better, return. I think like a Buc-ee's, which is private, a Wawa, which is private. There's a lot of other franchises that, with the resources of Alimentación Custa, they could have actually really made that into something else. Because what they're going to do at 7-Eleven is they're going to close a lot of the underperforming stores, keep a lot of the existing stores. I don't view 7-Eleven business model as particularly amazing. I view that a lot of the value, similar to McDonald's, is in owning the land and then what you can do with that. Because if you don't own the land, there's a lot of things that can, I think, go wrong, especially when you're doing a franchise model. So Alimentación Custa has a lot of land that they do own, but they also don't own a lot of the land too. So there's a little bit of a mismatch there. So I do not have a video on Copart. So if you guys want me to do these videos on Copart and all these other stocks, yeah, let's start getting this list going again. And eventually, I mean, I know that pretty quickly the list gets like filled up, because I remember I had like a list at one point, like 100 stock requests. So yeah, but I would love to start getting back into doing those videos, and it should be fairly easy for me to do, right? So dedicated videos and then give those out to you guys. But if I'm being honest, like right as we're wrapping up here, if you guys like the content, feel free to like, share, and subscribe. And in the description, you can see the link to actually get that join into the club. And you can have a lot more of the private content as well as the write-ups and stuff. And you can see the portfolio more up to date. All right. With that being said, thank you guys so much for joining in tonight. And I'll be seeing you guys on the next one.
Okay. We'll do it live.
Okay.
We'll do it live. It. Do it live. I'll write it and we'll do it live. Thing sucks. Yeah.